Hi, this is Roger Conrad. I'm co-editor of MLP Profits with Elliott Gue. What I want to talk about today is a subject that I've addressed several times in the past few months, and that is the subject of high prices for our MLPs. And these are primarily the result of very strong gains. If you look down the portfolio tables that we have on the site, you'll see that we've realized some pretty substantial ones since we've recommended these MLPs. And no doubt, those of you who've been with us from the beginning or even just over the past several months probably have some of these companies with some fairly outsized gains sitting in your portfolio. So the question a lot of people have this time of year is what to do with those gains. Should we take some of them? Should I be worried about the fact that companies are out there and issuing equity? That's been a continuing theme. Every time one of our favorites has gone out and issued more shares or more units, it's routinely been knocked down. That even happened to Enterprise Products Partners the last couple of weeks. So now you have an opportunity to buy that under our target of 42 once again. But these are the kinds of things that get people thinking that maybe they should take some profits. We have done that in the past. As some of you might remember, we sold Williams, the Williams partnership after it had more than doubled our money in a period of just a couple of months. So we've recommended taking the profit on that. We've also taken profits on other recommendations, such as Navios, which ran up quite a bit at one point. That's now also below a buy target, so we're very high on that once again. But it does beg the question, now we're into the end of the year, and is it time to take some of the money off the table? I think some of the urgency of that question has been done away with the fact that the low rate on capital gains has been extended for the next couple of years. Not officially yet, has yet to pass the House of Representatives and the Senate and so forth. But the compromise worked out with Obama and the Congress has basically taken that off the table. So we can look forward to another couple of years of a low capital gains tax rate. There's no big urgency, but it is very good practice to do what the fund managers do, what the big money managers do, and that is don't be afraid to take some money off the table in something that's really run up to a large extent. Obviously, the tax accounting with MLPs is a little more complicated because much of our dividends aren't taxed in the year they're received. This is not, of course, an issue with those who hold them in IRAs. You can easily match up and balance things out. But I do think it's worth our time and worth our while to, if you do have a huge profit in something, and if it's really run up to become a huge part of your portfolio, it's never a bad idea to take a little bit of money off the table and rebalance. That doesn't mean sell outright. We still like all of the companies we have in our portfolios, but a lot of these, if they have become a disproportionate piece of your portfolio, you do want to take another look at those. The risk of holding too much in a particular company is that something will happen at that particular company that derails the price or brings it down. That can be anything from a drop in an analyst recommendation to an equity issue. And you may wind up in a situation where you're holding a company that, even though it's a good one, loses value faster and takes you out of an overall bullish picture with a sector in general. And we've seen that happen over and over again. Again, if you balance your holdings periodically, you'll avoid that type of problem. So that's something, of course, you're going to have to go down and look in your own portfolio, make that judgment on your own. But as we hit into this holiday season, I think we do have a lot to be thankful for and a lot of very nice gains. So have a very good holiday, and we'll look forward to chatting with you next year.